Hey, what's up, guys? I'm back with the third episode, and this time I'm changing it up. I'm going to go ahead and talk about investments. Now, look, first off, SEC FINRA, I gotta say it. Not licensed, not certified, yet at least. So, this is not investment advice. This is just the strategies that you may want to look at or hear about in case you're investing. So, here are my top three things about investing that usually people do that they don't understand. So, number one, people invest because of FOMO, or as we know, fear of missing out. See, some people will say, well, that stock has been going up pretty fast. Let me go ahead and buy it. But little do they know, at least to my second thing, when people invest, it might be a pump and dump. See, a pump and dump is when investors may get together and they drive up the volume of a stock, and everybody's like, oh man, there's a lot of people coming in on this stock. So volume is the trading, the buying and selling of the stock. People are like, man, this stock is going all the way up. Let me take advantage. But soon they buy at the peak and then it dips. So rule number one, if you have fear of missing out on a stock, it is best that you do your due diligence, because due diligence means you do research. You do your background information and you see, is this stock really for you? Think of it for the long term, because a lot of times people don't understand. You're paying short-term capital gains tax, which is a lot more than just holding it for a year. You hold it for a year, you sit on it, like, okay, this investment got me a return or maybe a loss, but hey, I know about the investment now. Instead of just saying, oh, I'm going to invest my money in something that may or may not keep going up or go down. For example, the 2021 fiasco of GameStop, AMC, all those retail buyers going in, or retail investors. So everybody wants to pump up the price to get back at the people that were shorting it. And it did go up to 440 something like that dollars. But a lot of people decide, well, it's going to go up to 1,000 like, the people on Reddit said. And I'm not knocking anybody, because, hey, if you got your money, you got your money. But the thing is, people get so misconstrued and they get so confused about this thing. They say, well, I'm missing out. Let me go ahead and jump in. By the time you jump in, it's too late. You're going to buy at the peak, and they're going to say, well, it's going to go back up. The guys on Reddit said so. But the guys on Reddit also put in their tags, this is not investment advice. So that means you take it with a grain of salt, or you take it how you leave it. You take it how you get it. So if you decide to get it one way and it goes all the way back down, that's on you. They did not give you advice. They just told you what happened to them. So maybe they just had, the fortunate opportunity of getting into the stock. But fear of missing out is something that plagues a lot of investors and turns them into retail investors. They're not institutional, sophisticated investors where they understand, do due diligence of the things of the stock. So they don't do research and do background information. Just say, well, it's going up. Let me go ahead and invest. So the second point, pump and dump. Pumping and dumping a stock, why it hurts you. Because, like I said, you can buy at the peak and then it goes down. So when they pump all the way up, people think, oh man, well, the guys got this, the volume looks good. But then again, when everybody seems, oh, we reached a wall, let's go ahead and sell. And by the time they're selling, people still have hope and say, well, no, it's going to go back up. May or may not be true, but you have to be cautious and understand what sector of the market you're getting into. Because you can have a stock that, is being pumped and dumped, but it's actual good stock. It's actual stock that makes sense to have and it's for longevity's sake. Or you can be in a stock that's a penny stock. Which leads to my third point. People are trying to use the stock market as a casino. Thinking, oh, if I could put all my money into the smaller things, which, by research, the smaller things can have a larger impact or a larger gain than, your stocks that cost a lot more. But here's the thing, longevity. Do you want to pay short-term capital gains tax that can end up plaguing your wallet? Or do you want to pay long-term capital gains tax? See, you can have your investments for the rest of your life. But if you decide to have them for a short time, you're going to pay more tax on them because you're not letting them sit. You're not showing that you're sophisticated, institutional. You're not an investor that wants to really invest. You just want to make a lot of money, which, hey, to be anybody that makes a lot of money, day trades, etc., they know what they're doing. Even the people that pattern day trade, they know what they're doing because they dedicate time, due diligence to not just looking at a stock, but analyzing patterns, technical, fundamental analysis on everything. You can't be an investor and say, well, this person on this website or this app or this social media platform said, hey, this stock is going to go up because we're going to pump and dump it. Let me believe in them. But then they put in their tag, this is not investment advice. We're not licensed financial professionals. We're just telling you what we may do or what may happen. Keyword, may happen, not going to happen. So when you're investing, understand, do your research on the stocks and the bonds and the crypto, whatever you're investing in. Do your background research, because you may think, oh, I'm missing out, when in reality, you might just be losing a lot of money. So don't have fear of missing out. Do your due diligence. Get things like the S&P 500, the Vanguard. Get stuff that actually matters. Things that, have a track record of coming back and bouncing back over time. Sure, it may not be, 110% or 500% gain like some stocks may go up or some crypto assets may go up, but still, it's for the long-term sake of your investments. That way you have a better protection or better blanket than just dumping your money in the penny stocks, and those stocks keep going down, 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 and now you're selling at a loss. Now you have a loss on your record because you decided to use the stock market as a casino. So I like to keep it short and sweet for every video. So number one, fear of missing out, don't have it. Just do your research. Number two, do not go into pump and dump stocks. Do not think that the people online will save you, because everybody can say, hey, we're trying to pump this up. But there could be a lot of people going against that. And number three, do not use the stock market as a casino. You want to gamble money, you got sports, you got the casino itself. You can do a lot of things. But the stock market is really made to hold your investments so that way they can make money off of your money. They can generate a return for you because you're a shareholder of a company. And what do companies mainly need to do? Maximize shareholder value. And I learned that in finance class from University of Tampa, and of course my books from the Series 7 and Series 6. But besides that, that wraps up today's episode. I'm just going to keep it short, sweet, and simple. And like I said, fear of missing out, don't worry about it. Number two, don't chase a pump and dump. And number three, stock market, analyze it. It's not a casino. So thanks guys. Tune in for the next video and I'll catch you next time.